Good afternoon, ladies and gentlemen. In the interest of time, we should get things proceeding. It's my pleasure to welcome you to the Centre for International Finance and Regulation luncheon held here today. I would like to thank, firstly, members of the Financial Systems Inquiry Committee and their Secretariat, particularly David Murray earlier this morning, and also Professor Ken Davis, for their presence, as well as welcoming all of our industry stakeholders, regulators and members of the academic community. It's your attendance and your participation today that provides valuable views and perspectives to the community via, I think, what is a very timely workshop. On to our keynote speaker for today's luncheon, Professor Patrick Honohan, Governor of the Central Bank of Ireland and also a board member of the ECB. The Republic of Ireland, as you would all be aware, was one of the countries most impacted by the global financial crisis through 2008 and 2009. Faced a literal financial tsunami where it was battered by almost every force you could imagine: fiscal, economic, social and political crises. Its major banks collapsed in welters of scandals that highlighted poor underwriting standards and the behaviour that goes with that. The lack of internal and external oversight forced a 3-year period of economic stewardship by the Europeans, led by the European Commission, the ECB and the IMF. The country, still bruised and battered by this experience, re-entered the markets eventually, following a very comprehensive re-examination of their banking and regulatory practices. The extent to which Ireland is paying the price was underscored, I think, literally in the last week by the sentencing of the 2 senior executives of the Anglo-Irish Bank. The prosecution was designed to demonstrate the state's resolve and that accountability mattered. After a very complex trial, probably one of the most complex ever staged in Ireland, the jury found the executives guilty of an illegal share support operation, which was the last roll of the dice to save Anglo. And that bank has become a classic example for academics and practitioners alike of poor risk management and very rubbery perceptions or conceptions of probity. The judge did rule, though, that the behaviour of the financial regulator and, by inference, the wider Irish political establishment should also be taken into account in the sentencing. In fact, they weren't given jail sentences in the end. He argued it would be incredibly unjust to impose custodial sentences on executives who committed their crime with the implicit support and connivance of the state itself. They were given probations instead, and in fact the terms of which I think are still being worked through. The financial regulator, the judge concluded, was more anxious to solve the problem than to comply with the technicalities of law. So the task of transforming Irish banking culture and practices has fallen on Professor Honohan. He was appointed to the governorship of the central bank at the height of the crisis. He was a former professor of economics at Trinity College in Dublin and with extensive experience working in the IMF and a very prestigious CV. So he had the inevitable task of both negotiating the terms of the bailout and implementing the reform agenda imposed by the Europeans. His experience and that of Ireland does provide salutary lessons on what happens when a banking sector grows too powerful, too big and too myopic. It's an experience that Australia has always been conscious of and well capably led by figures such as Mr. John Laker down here to my right and his other regulatory colleagues, and it's one that we'll be conscious of, I'm sure, as we go through a comprehensive review of the financial system by David Murray and his colleagues. So Professor Justin O'Brien, who is the Director of the Centre for Law, Markets and Regulation at University of New South Wales, who is also a lead researcher for us with CIFR, he travelled to Dublin to speak to the Governor, who couldn't be present here today, so we have a videotape for you on the fall of the Celtic Tiger and also covers very comprehensively the future of European regulation. Here's the video of that, and I think you'll find it very impressive and very expansive. So thank you.
Governor Honohan, thanks very much indeed for joining us. Ireland, I suppose, went through the global financial crisis perhaps in a worse state than many other countries. What accounts for that?
Well, thanks for having me, Justin, and I'm aware that I have to think myself, and I have been thinking myself into Sydney on a May lunchtime, and we try to create the climatic effects here, but it's a bit drizzly, as people may be able to see behind me. But I'm in Sydney, and I'm talking to your audience here.
And the storm clouds are outside. Have they lifted?
We've had a terrible financial crisis here. It has been one of the worst, if not the worst, in terms of overall impact on the economy. In this wave of financial crises, and one of the worst ones ever. What type of a crisis has it been? Has it been different to other people's? This has been a classic boom and bust crisis here, based on overlending on property. So we can go back into many historic examples, and we see the patterns exactly the same. So it had no complexity of financial instruments. It didn't involve subprime. It didn't involve slicing and dicing, any of that. It was just a classic construction boom. And it was a boom associated not just with prices, but with extensive construction. So there was a volume as well as a price effect, leaving a huge amount of over-indebtedness.
So it would have happened irrespective of whether or not the global financial crisis happened. In other words, the collapse was inevitable.
The collapse was definitely inevitable. It was already, the boom had peaked well before September 2008. House prices and bank share prices had been falling for 18 months, and indeed a fiscal adjustment was already underway as everybody began to realize how over-leveraged the economy had become, and how over-dependent government tax revenues had become on revenue from the construction boom. Capital gains tax, value-added tax from furnishings of houses, and so on and so forth.
Well, to what extent then does this suggest that what happened in Ireland wasn't just simply a banking crisis, it was a wider crisis, it was also a political crisis?
The whole economic structure became distorted, but driven by overlending by the banks. I don't want to suggest that the banking was in any way a sideshow. The banking was central to the whole process of over-leveraging and of over-dependence on construction. The proportion of the population working directly in construction rose from its normal 6, 7, 8% up to 13, 14% at the top of the boom. And that doesn't count ancillary activities that were spin-offs from construction and so forth.
In that sense then, why did nobody shout stop?
Nobody shouted stop because, as usual, there seems to be something different in any bubble that takes place. There's a narrative that sustains a belief that we're into a new era. I would identify 3 or 4 factors which were quite influential in keeping this going so far, this bubble getting so out of control. First was the very rapid recovery in the 1990s of the Irish economy from an earlier fiscal crisis of the 1980s. The rapid recovery back up to the production frontier and to full employment was really unprecedented, and led to a long period of very high rates of sustainable economic growth, based on competitiveness, based on exports, based on solid and sustainable things. That took the economy to around 2000, but it led to a degree of over-optimism that a new era had begun, and people couldn't see why it wouldn't continue, even though the production structure changed in 2000 and became emphasizing housing and the construction of office blocks and so on and so forth. So the fact that there had been the Celtic Tiger boom up to 2000, people thought the Celtic Tiger was still roaring, but in fact the character of production had changed dramatically. The second factor was, of course, euro entry. High interest rates had been a characteristic of Irish as well as UK monetary policy for years and years, partly in Irish case because of the association with the European exchange rate mechanism, But over the years, Irish interest rates were 2.5 percentage points higher, exchange rate movement adjusted, than in Germany over the period of adherence to the European exchange rate mechanism up to 1999. But when we started to move into the euro, that interest premium dropped. So cost of capital much lower. Also access of the banks to funding. They could borrow from abroad without taking any exchange risk. And of course that was an open-ended. So the banks really were able to source money at low interest rates. So euro, very important factor. Third factor I would say was the demonstration effect of similar property bubbles in the UK, in parts of the US, in other places, which were very, especially UK and US, very influential in the thinking of bankers. There's no problem now. Financial engineering has eliminated risk. Everything can be managed. You can get as much money as you like. So the global financial boom helped keep it going. And finally, but also very important, I think the light touch regulation, to summarize a very complex story, light touch regulation meant that financial regulation from this building that we're sitting in here was pretty ineffective during that period.
And that leads us to the question of the underpinning regulatory philosophy. Throughout that period, there was this belief in light touch regulation that principles were better than rules, etc. But to what extent, ultimately, do you think was that not necessarily economically rational, but ideationally constructed?
Well, I think that I would emphasize two main aspects of that. First thing is that we have an offshore financial center here, the IFSC, which grew from the 1980s, very substantial. Now, it's full of solid companies, but in order to attract those companies, definite effort was made to say, we are going to be a friendly regime to incoming companies. So that created an atmosphere. I've had that removed. It's not a goal of the central bank. It had been a goal of the central bank to develop the financial sector. That has been removed from the legislation. That's not there. I want to emphasize that. But it was at that time. So it influenced that we want to get foreign companies in. Our own banks, of course, will be all right, so we don't have to worry about that. So that attitude. Secondly, in the way in which regulation was imagined, taking from examples in other countries, the regulatory approach was to say the market really works. All you've got to make sure is that the firms in the markets are properly governed and have the proper incentive and management structures in them. So the emphasis in any kind of supervision was, are there good internal rules and structures in the regulated entity, and are they being adhered to? Very little emphasis on, well, let's look at their balance sheet. Let's look at where they're making money. Let's look at the risk profile of that. Very little quantification of that, so that, of course, if a bubble gets way out of hand, then it does matter that you actually look at the numbers and say, I don't care about the basic principles here. This is so far off the scale that it must be wrong.
And of course, there was a problem in 2006, 2007 when the New York Times described Dublin as the Wild West of global finance. You mentioned that there was a concern about the IFSC, but the domestic banks would be fine. Well, just last week we had really quite scathing judicial criticism of that regime.
Absolutely.
Was that regime justified?
No, the criticism was justified.
Yes.
And indeed, when I came into this job, I was asked by the government, look here, we want to have a report from you, a backward-looking report on regulation. And I took the opportunity to really dig deep, not just into regulation, but into, to some extent, the regulated entities. And that is actually quite, although I say it myself, I think there's a lot of interesting meat in that for anybody trying to study how regulation can go wrong. We tried to be as open and detailed as possible without actually identifying particular institutions that would be entitled to confidentiality, so people could look at that report. And
so the problem
so I have been as critical as the judge of last week in my report of 4 years ago. So there's nothing new from that point of view in this idea that a regulatory system was really not fit for purpose.
And so this is a cultural problem as well as a structural problem, would you say?
Well, it's cultural, not in the sense that we can never get Irish people to do a thing like this properly at all, but it's an institutional culture was developed around we're here to attract foreign companies into the IFSC, and we can be quite confident that the good old traditional 200-year-old Irish banks will be okay. Well, actually they weren't. As somebody pointed out, actually a former chief executive of one of the biggest bank of Ireland, he said it took Bank of Ireland 200 years to get to a balance sheet of 100 billion euros, and I can't remember, 5 years, 6 years or something to double that again. So that was the situation that was allowed to happen because of an overall environment in which you said, well, you're not going to question what Bank of Ireland are doing because it's obvious that they're going to be all right.
So as a consequence of that mismanagement within individual institutions, perhaps basically a flawed belief in market ordering, Ireland, very famously had to go into what Rory Quinn, Irish Minister, described as a period of stewardship. It's now out of that stewardship. Has it regained its sovereignty, do you think?
Well, I mean, as somebody who has been in and out of the Bretton Woods institutions over the years, they don't seem to me as great big ogres taking away a country's sovereignty. It became, the financially and quantitatively the challenges became too big. The government was, that's the former government, was determined to adjust the fiscal imbalance that had emerged, to fix the banks, to inject capital into them, and they had gone down that road, but they were at the limit of their financial capacity to do that, and that was seen by the markets. And the market said, "Wait a minute, this could get too extreme," and the spreads went too high. So we went to the IMF, we went to the European institutions, and the package was put together. And as you said, that's been a 3-year package, and it has underpinned. Of course, it has. As you know, these missions come around every a few months, and they say, "Well, haven't you done all these things?" All the things that were done were things that were agreed to by the Irish government. In fact, built on a pre-existing policy framework. But it's easier to get these things done if the Troika are going to come next month and say, you said you'd do it by the end of April,
so
and
you
now it's the 1st
excuse,
of May.
So to speak.
You have a political excuse, you have the momentum, you have no opportunity for second guessing, which is always something that delays action. So we accelerated a lot of reforms that we, the administrative and political system, actually wanted to do, even though there may have been some hesitations and doubts, and they would have happened more slowly. So it certainly helped push things along, but in a direction which was already broadly accepted by the main political parties.
So if one wanted to look at the future of banking regulation in Europe, is Ireland a good place to look at?
I hope so, because we've done a lot to change how we conduct financial regulation here. And of course, as you know, banking regulation and supervision is becoming centralized in the euro area, and possibly in future other countries of the European Union who might want to join the euro area for that purpose. And so the main banks here, the ultimate responsibility of their supervision will pass from this building to Frankfurt, although of course the main work will still be done by Central Bank of Ireland staff. In the past 5 years, we have done a lot of things to change the way in which we work. Of course, we've increased the staff considerably. Maybe that won't be effective, but it's very hard to argue against the need. When you consider the costs of the previous failure, it's very hard to argue against properly funded and sufficiently staffed regulation. So there's been a very substantial increase in the staff of supervision.
Is it a more intrusive regulatory regime?
It is intrusive, but I want to go beyond that to say that you need to do a number of things. You can't just say, well, we've changed the label here and it's now intrusive instead of light touch, but actually we have the same people and the same competences and the same way of dealing. Top staff hired completely in from outside the organisation.
And indeed outside the country.
and indeed outside the country, and then through the organisation, staffing up at all levels, bottom level, middle level, top level. We also had an examination of the way we work as an organisation, our principles and behaviours. We had extensive consultations and discussion groups inside that make it sound a bit touchy-feely, but to make people aware that we have to behave in a different way in our communication to each other, communication up, down, sideways, so that people know what's going on, so that the economists know what the supervisors know, and vice versa, and there's interaction of information, and that if people have some doubts, that they have the confidence to speak up and challenge their bosses and say, I don't think you're doing enough there. So we conducted that cultural change within the organisation. We've codified a lot of behaviours for the banks. We've especially on management of mortgage arrears. We have, of course, a role in consumer protection, but not both on the consumer protection and the prudential side. We have been laying out targets and codes of conduct for the banks in managing this, which is, of course, their biggest challenge at the moment.
So in many ways, in summary, you've got a situation where Gordon Brown, the former British Prime Minister, said at a very early stage in this crisis that there was a need for a new social compact with banking. Has there been a new social compact with banking in Ireland?
I think this is unfinished business. There's still a great deal of anger about what went wrong, not only with people who bought houses at the top of the boom and paid, undertook unaffordable loans in some cases, but everybody who's been hit by the increased taxes, by the increased unemployment, by lower wages. The public service wages have been lowered in several steps, quite considerably in nominal terms. There is a lot of anger, and it is all directed, or most of it is directed towards the banks. So is there a new social compact? It doesn't look like a social compact to me, but I think the banks recognize that they owe a lot to society, and they need to work sensitively in what's continuing to be a very protracted workout of distressed and impaired loans.
Well, that then finally leads one to the question of what the optimal size of a financial sector could or should be. Has the financial sector in Ireland been cut down to appropriate size?
It's certainly shrunk dramatically. I would warn people against looking at some headline numbers, because we still have some very large firms as well as a large number of smaller firms in the IFSC that tend to swell the overall Ireland banking assets to GDP ratio. So we have big firms like Merrill Lynch have a huge operation of European scale here. There's Zurich Insurance. So a number of firms make that ratio much higher than it really is in terms of the institutions that deal with the domestic economy. Now, those institutions, at the time of the even though they had already started to delever at the time of the bailout, they had loan-to-deposit ratios in the 170, 180%. And I remember a nice negotiation with the Troika people who said, look, not only have you got to put in more capital into the banks to convince the markets that there's going to be enough, but you've got to get the banks to deleverage faster. Pressure in that case particularly coming from the ECB side, which had been financing the bank's position, because the bondholders were being repaid, the foreign depositors were being repaid, and this all being replaced with central bank money. So a target was set for the loan-to-deposit ratio for the banks, and I remember one number was proposed, and we said, I'm not sure we can get it there that fast in 3 years, and we proposed on the Irish side back another number. So the final number was 122 and a half, and that's where the half comes from, because it was halfway between the two proposals. Very dramatic deleveraging. They're now below that ratio. Probably, definitely more to go. Loans are being repaid faster than new loans are being made. I'd like to see new loans being made a little bit faster. The economic recovery needs more lending, and lending is cautious here, as it is in all of the peripheral European countries. But the banking system will be smaller. Now that's in quantification in terms of total assets, but also number of banks. And here we've seen a shrinkage in the number of banks dealing with the domestic economy. There have been some exits. Some of the foreign-owned banks have exited altogether. Others are, in a way, treading water. They're here, they have shrunk, and they're not doing that much new business. So in terms of active lending banks, we don't have enough, actually. So I would say we've overdone the shrinkage in terms of number of entities. And so I'd like to see the situation stabilize with a larger number of retail banks able to and willing to do business here. And they will come because the surge of confidence that has come back into the economy now will attract those foreign institutions, particularly after the European stress test, and they say, well, that's over with, now what can we buy? I can see foreign entities will come in. When or how, not sure, but there's money to be made, obviously, out of Irish banking.
Rahm Emanuel, the former chief of staff of President Obama, now the mayor of Chicago, very famously once said, you should never let a crisis go to waste. Crisis is an opportunity.
Yeah.
Do you think Ireland has grasped the opportunity of the crisis?
Well, of course, when you're in the central bank, you can always complain and gripe that the government doesn't do enough and doesn't take enough opportunity. A lot has been done in terms of taking the opportunity to get reforms implemented. Clearly on the banking side, we've done an enormous amount of work, but that has been not just dealing with longer term reforms, it's been correcting a crisis situation. In non-banking, a lot has been done. I would like to see more done. There are a number of things which would make the economy work more effectively for all the members of society. So we'll have to do that in non-crisis times.
So a work in progress.
Oh, it's always a work in progress.
Governor Honohan, thank you very much indeed for joining us.
Well, thank you very much. Justin O'Brien, thank you for the interview. Very good. The Professor, yes, thank you. First class effort. Also, thank you to Steve Harker for his introductory words as well. We're going to move to our second breakout sessions. We are back on time, so those breakout sessions will run through till 3 o'clock, and then we'll reconvene here for Professor Justin O'Brien moderating a panel of 5 experts. Okay, see you soon.